Is busy season taxing you? This is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm the assurance partner at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or CLA. Okay, so we got two topics that I'm going to really talk about today. You've heard me talk about them a bunch already. I'm not trying to be repetitive, but we are in a busy season, depending upon when you're watching this. But we are in a busy season. I'm anticipating some of you are facing some of this, will be facing some of it. You may have already addressed it and think that you've addressed it properly. And what I tell you, you might say, oh no, and you have to put the brakes on. So let's go over the first one. I know you've heard it a lot already. I'm going to go over it again though, but leases. So why am I bringing this up? Well, the FASB actually just had a meeting about a week ago, and they talked mainly about leases. Now, if you remember back in, I think it was November, they put out an exposure draft relating to common control leases. And I recommended everybody go get that exposure draft, read it, comment on it. I had wished that the FASB would have scoped out common control leases. You know, those are leases between entities under common control. They don't like to use the words related parties, so they use common control. So I'm going to be using that, you know, for the rest of this time. And I wish they would have scoped that out, but they didn't. In fact, they re-emphasized the points that they were making in that exposure draft, which I'm going to tell you about now. And you really need to focus on this. And there's one particular area you've heard me talk about. I'm going to go into it right now. The board affirmed its decision to provide entities within the scope of paragraph such and such with a practical expedient to use written terms or conditions for determining whether a lease exists, and if so, the classification of the lease. And you're sitting there saying, Brad, this doesn't sound really odd. I mean, it sounds like what you're talking about, we've been thinking about, we've been doing, or we understand it completely. Well, the practical expedient may be implied on an arrangement basis, which is good. An entity applying the practical expedient is not required to determine whether those written terms and conditions are legally enforceable. Whew. Okay, that sounds good. We have a written document between these entities under common control. You don't have to determine if it's legally enforceable. Okay? The rent may not seem to be fair value. The rent it may seem one-sided. Either way, you don't have to determine if there's legal enforceability as it relates to that written agreement. So they came to that conclusion. That's good. However, the second part, if no written terms or conditions exist, here's where the problem comes up. Now, I know we have some clients, and I won't give the names out of the types even at this point. I'll just say they are nonprofit, particularly where I see it. I've seen it in some commercial, but I've seen it in nonprofit. But the arrangement between the parties is not written. And they just say, it's month to month. It's month to month. Brad, is that written that it's month to month? Or is it just, we don't have an agreement, and it's month to month? So if you have situations either in your own entities or for your clients where you have arrangements between entities under common control that are not written, you have to consider this. If no written terms or conditions exist, an entity is required to apply 842 on the basis of legally enforceable terms of the arrangement. What does that mean? You're saying legally enforceable terms of the arrangement, but if no written terms or conditions exist. So you have to actually look at the arrangement, look at the relationship in the situation, and determine if there is a legally enforceable situation. Now, what you're not going to want to hear, and what I actually heard a presenter say one time, is you may have to engage an attorney to determine it. I'm saying that also because you as an accountant don't want to start practicing law or give an opinion or a comment as if it is a legal comment when you're not able to do that, okay? You may think you know it, but I would caution you on that. Things that you can think about as you're going through this is, are there underlying situations which would create a view of legal enforceability? And the one example I give is, I have a relationship with my company has a relationship with a related entity. We have an arrangement and I'm paying something that's called rent or lease expense, but we don't have anything written. But that related party has a mortgage on the property. And while I don't know why the bank would have lent on the property without a lease in place, but let's just say they did, okay? Could there be a legal enforceability of the bank or somebody coming back and saying, no, you have to pay this rent. It is in place because there is a mortgage or something in place that makes it, in effect, a legal obligation. So keep that in mind. And that's just one example. Somebody gave me an example about estate planning where you could have a lease in place that actually puts some value to the estate. So there are situations, and you may have to have somebody else give some sort of opinion on this. I mean, somebody talking about legal. Moving on to another area, which I thought that this was good, but very interesting. Leasehold improvements. How long have you been amortizing your leasehold improvements? Well, if it's building, it's 39 years. Obviously, it's what you've been doing. Or if it's equipment, you just took 7 years or 10 years, whatever you thought was right. However, here's the problem that we have. Depreciation of leasehold improvements is supposed to be the shorter of the lease term or the estimated economic life of the lease. Okay? Now, I'm not talking about equipment as much. We're talking strictly about leasehold improvements. This is the most common. The board decided that for all entities, leasehold improvements associated with common control leases are required to be amortized by the lessee over the useful life of the leasehold improvement to the common control group as long as the lessee controls the use of the underlying asset through the lease. If the lessor obtained the underlying asset through a lease with another entity, then in essence you should use the life that they would be using as it relates to that lease. So if you have leasehold improvements and you're renting from an entity under common control, you can use the 39 years if that's what they're using, or the 30 years. And I'm not telling you to use 39 or 30. I'm telling you that you have the ability now, or you should be using the life that the entity under common control is using. Okay? Here's some of the glitches though. Accounting for the transfer between entities under common control is done through an adjustment through equity. So you leave the property, you're done, but you haven't fully depreciated the leasehold improvement. That remaining balance is treated as a transfer through equity. Okay, and that's the big area. The big concern that they have is, and I did hear a presenter talk about this, you have an S Corp, you have a partnership. Either way, you now have what's a distribution going through equity, or a distribution go through equity, and it could have an impact if there's no basis, could have some taxability impact. And I did ask somebody about this, saying, what's with the FASB doing this, and what's the possibility that we could have tax situations because of this, legal situations because if there's disproportionate distributions in an S Corp? And the comment was, the FASB isn't concerning themselves about the tax impact. They have to concern themselves about what they deem to be the accounting impact. So check this out. Make sure you look into it, because this could impact you. What I find interesting, and I didn't even talk about the implementation on the unwritten leases, what they say here is any new leases is done prospectively. That's pretty straightforward. Any new lease arrangements for leasehold improvements is done prospectively. For those leases that are in place on 1/1/22, let's say, because you adopted it this year, or last year, you adopted it, for the fixed assets that are in place, the adjustment for the new life of the assets is done retrospectively to the beginning of the period which the entity first applied 842. Any leasehold improvements that otherwise would have not been amortized or impaired are required to be recognized through a cumulative effect adjustment. So if you're adopting 842 and you're putting your right to use asset and your lease liability on the books, and you're doing it as an opening adjustment to retained earnings, you now should be considering, or if it's effective, you should be considering the effects of the leasehold improvements, and if you're going to be truing up your accumulated depreciation. Okay? Last thing I want to go over real quick, I'm watching the time, is accounting for bait. Now, if you don't belong to the Center for Plain English Accounting, which is an AICPA service, you would have not gotten this information. Now, FASB really has not addressed, I said pass-through entity tax. If you look at the guide in 740, there's really no discussion as to something like this, and you read and you can't determine where it is. So fortunately, the Center for Plain English put something out. But if you're not a member of them, and I'm not here pushing you to be a member, if you're not a member of them, you didn't get this good information from them. Now, I say it's good, but I completely disagree with what they put out, and this is what you should be aware of. They gave 3 different examples, and if you read the examples, example 1 kind of matches New Jersey. I'm talking mainly to New Jersey people here, so I'm going to mention New Jersey. If you read example 1, it kind of matches New Jersey, and it says, and I'll read it real quick, Entity A, partnerships have 2 partners, 1 and 2. They have nexus in New Jersey. It says in J. And Entity A allows partners 1 and 2 to file a tax return and use their pro rata share of Entities A income tax payment, says income tax payment as a credit. Because the owners may file a return and utilize Entities A payment as a payment against their personal income tax. Does that sound familiar to you? The income tax would be attributable to the owner by Jurisdiction J's laws. In the end, because the income tax has been attributed to the owner, the payments would be treated as a transaction with the owners, in other words, a distribution, and not a tax. And I know a lot of accountants have been treating it as tax. Now, this is non-authoritative guidance, but it's something that you should be aware of. Now, this has been analyzed for the many different states. If you want more information, you can call me. I'll be happy to talk with you about it. Happy to talk with you my feeling on this. But that's an editorial comment. But I recommend that you look into this because you've been preparing your financial statements. You've been helping the clients with their financial statements. And you may have been treating this as tax, which I'm not disagreeing with, but you may have been treating it as tax. You've got to document your reasons why, because there is some literature out there that says it should be a distribution. And you have to consider all the other states that now have it. So with that, a few closing notes. The NJCPA Convention and Expo is taking place June 13th through the 16th in Atlantic City. If you haven't taken the New Jersey Law and Ethics course this triennial, you can take it in person at the convention. Go to njcpa.org/convention for all the information. If you've missed any recent podcast episodes, you can catch up at njcpa.org/podcast. Last but not least, be sure to join the NJCPA Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening. I mean, carrying this, you only have to have arms like this.